Welcome to this short lecture on the economics of climate change and practical policy responses. Over the next few slides, we'll walk through the economic risks, the value of early action, and concrete policy tools that can drive clean innovation while protecting equity. Think of this as a roadmap for turning climate challenges into opportunities for cleaner growth and better public health. This slide shows projected GDP paths under different warming scenarios and highlights wide uncertainty with a pronounced asymmetric downside. The key takeaway is that while there is a small chance of modest upside, there's a significant risk of large negative outcomes from unchecked warming, and the visual also points to concrete threat vectors like sea level rise, increased disasters, and growing inequality that would fuel economic losses. Here we look at the Stern-style cost-benefit framing, where stabilization has upfront costs roughly estimated relative to global GDP, but co-benefits like cleaner air, health improvements, and energy efficiency offset much of those costs. The chart emphasizes that many abatement investments pay back through reduced health and resource costs, reframing mitigation as high-return investment rather than a pure burden. Economists overwhelmingly agree that the damages from delaying action exceed the costs of acting now, and the slide sketches that contrast three futures. Inaction risks lower long-run growth and deeper inequality, while timely action unlocks zero-carbon technologies and mid-century targets that are cost-benefit justified today, making the economic argument for aggressive near-term policy clear. Carbon pricing is presented as a balancing act between marginal abatement cost and avoided marginal damages, and the diagram helps explain the optimal tax intuition. More importantly, a predictable price signal drives innovation in low-carbon technologies, shifts consumption toward cleaner choices, and generates revenues that can be recycled to cut distortions or support vulnerable households. Beyond pricing, this slide maps complementary policy tools that overcome market failures and speed deployment. Standards, green public investment, and innovation subsidies feed R&D, network infrastructure, and information flows, which in turn accelerate clean technology scale-up, build political feasibility, and capture ancillary benefits such as energy security and air quality improvements. Framing the transition as a new development wave highlights how smarter cities, efficient buildings, and renewable grids can boost productivity, create jobs, and improve public health. The idea is that technology revolutions spur investment surges, which can translate into decades of higher growth, so climate policy can be an engine for prosperity rather than a brake on the economy. Distributional impacts are central. Poorer and hotter nations face disproportionate suffering and have limited adaptation resources, so policy must address equity. The slide shows how synergies between climate action and poverty reduction can produce double dividends, and how revenue recycling plus targeted adaptation finance can shield vulnerable households while supporting resilient, inclusive growth. Integrated assessment models carry high sensitivity and uncertainty driven by unknown technology paths, discount rates, and damage functions, and the slide urges robust policymaking under that uncertainty. The recommended decision criteria are straightforward. Implement stringent mitigation now on known risks, monitor outcomes, and adapt policies as evidence evolves, and preserve flexibility to adjust to future surprises. This recommendations page bundles practical strategies economists favor. Set a rising carbon price, eliminate fossil fuel subsidies, scale clean R&D, invest in resilient infrastructure, and embed equity safeguards. Acting decisively today lowers committed damages later and positions economies to lead the zero-carbon transition, turning current policy choices into long-term economic and climate benefits. To summarize the key messages, costs and benefits show that climate damages already often exceed mitigation costs and co-benefits help finance action. Policy plus innovation drives the needed technological shift, and uncertainty argues for a precautionary, adaptive strategy because delay locks in higher future costs and risky high-carbon assets. Finally, applying the toolkit means starting with local data and regional model adaptation, running carbon tax simulations to weigh trade-offs, exploring political economy and revenue recycling to enhance acceptability, and tracking technology cost curves to identify investment opportunities, all supported by continuous micro-learning. So today's insights inform tomorrow's robust climate decisions.